Think about the last time you checked your bank account. Not the quick glance you do at the grocery store checkout. The real check. The one where you sit down quietly and you actually look at the number that's there. And you think, I work hard. I always have. I show up. I do what I'm supposed to do. And somehow that number doesn't feel like it reflects any of that. You're not broke. You're not in crisis. But you're not where you thought you'd be either. Maybe you're in your 30s with a 401k you barely understand and a savings account that grows slower than your rent. Maybe you're in your 40s and you've been meaning to invest for years, but something always comes up. A car repair, a medical bill, a vacation you needed, a life that kept costing more than you expected. And when you do the math, quietly, honestly, the numbers don't add up to the years. Here's the question that nobody really answers. Not people who were careless, not people who made terrible choices, just regular, decent, hard-working Americans who did more or less everything right. That question has been sitting in the back of a lot of minds for a long time, and this video, built around one of the most detailed financial biographies ever written, might finally offer an answer that actually makes sense. Here's what nobody tells you about money in America. The system you grew up in was designed to make you a consumer, not an investor, a consumer. From the time you were a teenager, you were shown what success looks like. Nice car, nice apartment, the right clothes, the right phone. And the message always was the same. If you earn it, spend it. You deserve it. You worked hard. So you earn and you spend. And then you earn a little more and you spend a little more. And every time your income goes up, your expenses somehow keep pace. The lifestyle expands to meet the paycheck, and the gap between what you make and what you keep stays almost exactly the same. Meanwhile, the people who actually end up wealthy are doing something quietly, almost invisibly different. They're not making dramatically more money, not at first. They're not driving Ferraris or living in beachfront mansions. They're doing something that looks almost boring from the outside. They're letting time do the heavy lifting. There's a book written over 5 years based on hundreds of personal interviews that gets into the details of how this actually works, not in theory, in real life over real decades, through the lens of one man's decisions from childhood all the way to old age. It's called The Snowball, written by Alice Schroeder, and it's not just a biography of Warren Buffett. It's a study in what happens when someone truly understands a force that most people intellectually know about but emotionally ignore. That force is compounding, and once you understand it the way Buffett understood it at 11 years old, the way it quietly shaped every single decision he made for the next 70 years, you start to see why so many smart, hard-working people end up in a place that doesn't match all the effort they put in. Warren Buffett grew up in Omaha, Nebraska. Middle-class family. His father worked as a stockbroker. And from a very young age, something clicked for Warren that simply does not click for most people. He saw time differently. Not as something that passes, as something that builds. When he was 6 years old, he was buying packs of chewing gum from his grandfather's store and reselling them door to door at a markup. By 11, he bought his first stock, 3 shares of Cities Service Preferred. He tracked the price every single day. And the question that ran underneath all of it, the one he kept coming back to, was always the same. How does this grow over time? He used to describe it with a simple image, rolling a snowball down a hill. The snowball starts small, almost insignificant, but as it rolls, it picks up more snow, and the bigger it gets, the more it picks up. Given enough hill, enough time, something tiny becomes something enormous. But here's what people miss about that metaphor.
Buffett wasn't just talking about money. He was talking about every decision, every habit, every reputation, every relationship. The snowball metaphor only works if you have two things: wet snow, meaning the right conditions, the right habits, the right information, and a long enough hill. And the hill is time. Time you cannot manufacture, time you cannot get back once it's gone. This is the part most financial advice skips, not because it's complicated, because it's uncomfortable. Because it means the decisions you're making right now, today, are either adding to the snowball or they're not. And most of us, if we're honest, have been making decisions that feel right in the moment, but do almost nothing for the snowball. One of the most interesting things Alice Schroeder uncovered in writing this book is something Buffett called the inner scorecard. Most people go through life running on an outer scorecard. They measure their success by what other people see: the car they drive, the neighborhood they live in, the title on their business card, the perception others have of their choices. And this doesn't make anyone a bad person. It's deeply human. We're wired to care about social standing. It's in our biology. But it has one very specific consequence when it comes to money. When you live by an outer scorecard, your spending becomes signaling. You buy things not just because you want them, but because of what they say. And the cost of that signaling, compounded over decades, is enormous, not just in dollars, in the loss of time that those dollars could have been working. Buffett famously drove an old car for years after he could have bought almost anything. He still lives in the same house in Omaha he purchased in 1958. Not because he's cheap, because he made peace a long time ago with a different scorecard. He wasn't performing wealth, he was building it. And the people around him who were performing it, the bigger house, the nicer car, the designer suits, many of them ended up with far less to show for their lives than a man who looked from the outside like he was barely trying. Now think about that in your own life. How much of your spending, honestly, is about what you actually want versus what you want people to think? That's not a judgment, it's a real question. Because the gap between those two things is often exactly where wealth quietly disappears. Here's something most people don't fully reckon with. The math of compounding works in both directions. When you invest consistently and let time do its work, the numbers grow in ways that feel almost unreal. A modest amount, invested early and left alone, can become something remarkable decades later, not because of genius, but because of patience and time. But when you carry debt, credit card balances, high-interest loans, the same math works against you every single month. Every month you delay investing is a month of compound time you will never recover. Every year that passes without that snowball rolling is a year that is simply gone. And here is the quiet tragedy that plays out in millions of American households. People know this. Most adults have heard about compound interest. They've been told to start early, invest consistently, avoid high-interest debt. They know. But knowing and doing are completely different things, because the pain of giving something up today is immediate and real, and the benefit of that sacrifice, it lives 30 years in the future. It's abstract. It's invisible. It doesn't feel urgent. So you buy the thing today. You take the vacation. You upgrade the car a little earlier than you planned, and you tell yourself you'll get serious next year when things calm down a little. And things never calm down. Buffett understood this almost as a child, and so every dollar he considered spending, he filtered through a single mental move. What is this really costing me? Not just today, but in what it would have become. He reportedly said that every dollar felt larger to him than it did to most people because he could see its future. That's not a fun way to think about a dinner out, but it's an honest accounting of what spending really costs. And it's the kind of thinking that separates the people who build wealth from the people who make solid incomes and end up with very little to show for them. One of the things that made Buffett different from nearly every other investor of his generation, and from most people in general, was his willingness to say two simple words: I don't know. He didn't invest in things he didn't understand. Technology companies, complex derivatives, industries he couldn't get his mind around. He stayed away from them, even when everyone else was making money hand over fist. People thought he was being stubborn, outdated, missing obvious opportunities. But time and again, the thing he refused to buy because he didn't understand it turned out to be the thing that imploded and wiped out people who thought they were geniuses. He called it his circle of competence. Know what you know, stay inside that circle, and when you're tempted to go outside it because something looks exciting or because everyone else is doing it, don't. This is relevant for regular people in ways that have nothing to do with picking individual stocks. Think about how many financial decisions Americans make based on what seems to be trending. Crypto, real estate schemes, NFTs, leveraged options on apps that make it feel like a game, a tip from a friend, a thread that went viral. And sometimes these things work out, but more often people are moving in territory they don't fully understand, chasing returns in something they can't actually evaluate. And when things go wrong, the losses aren't just financial. The time is gone too. What Buffett modeled quietly for decades was the discipline of doing nothing rather than making a move you don't understand. In a culture that worships action and hustle and constant movement, that kind of stillness feels almost radical. The track record, though, speaks for itself. Buffett has said many times that it takes 20 years to build a reputation and 5 minutes to destroy one. He didn't say this as a cliché. He said it as someone who watched it happen to people he knew, to companies he owned, to the culture of Wall Street during some of its ugliest moments. The most public test came in the early 1990s during the Salomon Brothers scandal. Buffett had a significant investment in the firm. When a massive bond trading fraud broke into the open, Buffett stepped in as interim chairman, not because he had to, but because he believed it was right. He stood before Congress. He spoke plainly. He said that at Berkshire, his company, they would lose money in the markets, but they would not lose their reputation. That moment was not just a leadership story, it was a financial one, because the reputation he protected in that room was worth more than any trade, any deal, any quarterly return. People trusted him. That trust brought deals. Those deals compounded over decades into something no spreadsheet could have predicted. Most people make decisions based on what benefits them right now, in their finances, in their jobs, in their relationships. The short-term gain, the immediate reward, the easier path. Buffett consistently made decisions based on what would look right to him in 10 years, not what would look right to others, what would look right to himself. That's the inner scorecard working in a different context, and the compound effect of consistently choosing integrity over convenience turns out to be one of the most valuable investments a person can make. There's a moment in the Snowball, toward the end, when Schroeder presses Buffett to reflect on his life, where he says something that most people in his position would not say. He talks about luck. Not luck in the way people usually mean it. He's not talking about winning something by chance. He's talking about structural luck. Being born in the United States in the 20th century, into a family that valued education and gave him access to information. Having a mind that was wired, almost accidentally, to find numbers and businesses endlessly fascinating. Being in the right place at the right time in history for those particular skills to matter enormously. And he holds all of that with genuine humility, not false modesty, real recognition that the hill he happened to start on was not a hill everyone gets. Because here's what that tells you. The snowball doesn't roll in a vacuum. It rolls on the snow that's already there. The environment matters. The habits matter. The information you have access to matters. The people around you matter. You can't control what hill you started on, but once you understand how compounding actually works, once you see clearly that time is the single most valuable asset in the equation, you can start to make different choices. Not dramatic ones, not overnight transformations, small, consistent, patient ones. That's the whole game.
So come back to the question from the beginning. Why do hardworking Americans end up with so little after decades of steady effort? The answer, after all of this, isn't complicated, but it isn't comfortable either. It's not because they were lazy. It's not because they didn't earn enough. It's not even because they made catastrophic mistakes. They were focused on income when they should have been focused on compounding. They were running on an outer scorecard when they should have been building by an inner one. They were spending to signal rather than saving to grow. They were chasing what felt exciting rather than staying inside what they actually understood. And they kept telling themselves there was more time, while time was the one thing quietly slipping through. That's not a personal failure. That's just what the default looks like in a system that was built to keep you spending. The machine runs on consumption. It just wasn't designed to help you build. You don't need to become Warren Buffett. That's not the point of any of this. But there are 3 things this book quietly invites you to look at in your own life. The first, when you make a financial decision today, are you feeling the full cost? Not just the price tag, but what that money would have become if you'd given it time. That's an uncomfortable way to think, but it's an honest one, and it changes decisions in ways that nothing else quite does. The second, what scorecard are you running on? Whether you realize it or not, you're already keeping score somewhere. The question is whose standards you're using. Are you building towards something that actually matters to you? Or are you performing a version of success that looks right from a distance? And the third, the one that might be the hardest and the simplest at the same time, are you doing anything, any amount, consistently, in the right direction? Not perfectly, not at scale, not when you figured everything out, just consistently. Because the snowball doesn't need you to be brilliant. It doesn't need you to start with a lot. It just needs time and a direction and the patience to let it roll. The hill is still there.
Warren Buffett is in his 90s. The vast majority of his wealth, almost everything he has, was built after his 60th birthday. That is the nature of compounding. It is slow, and then it is sudden. And the quiet message underneath everything in this book is this: not next month, not when things settle down, not when the market looks clearer or the timing feels right. Now. Because the snow doesn't wait, and the hill is only getting shorter. If this video changed the way you think about time and money, even slightly, stay with this channel. There is more here that goes deeper into the patterns behind wealth, the psychology of decision-making, and the quiet choices that shape a life. Take care of yourself, and keep thinking.